Hey there, everyone. Jamie with Sell for 1%, joined by the Sell for 1% gang and Ryan Cochran, lender over at NFM, here today to talk with us about some changes with interest rates and lending in general, mortgage lending. Ryan, what kind of updates are we looking at this week?
Yeah, great question. So the golden question there. So we have been seeing interest rates steadily kind of going up this past 2 weeks-ish. I don't think that that's going to be something that holds on. We're still seeing interest rates anywhere from, a 6.5 to a 7.5, low seven, just depending on the client's specific needs, the borrower's wants, if they're a lower credit profile score, higher credit profile score, loan amount, et cetera, et cetera. But yeah, the big news that everybody's kind of talking about right now are some of the adjustments and fees that are going to be getting updated next week on starting May 1st. What the FHFA, which is Federal Housing Finance Agency, is doing is going up with a lesser qualified credit profiles in what they would be charging them. So I guess technically lowering, not going up, in what their fees would be charging them. And for higher qualified credit profile scores, they're going to be upping their fees on what they are getting charged for them to get that specific interest rate. So what this all means, and I'm sure what you guys have been seeing in social media and what some lenders are posting to get kind of like the clickbait hysteria going, is they're blaming Biden and they're calling it like the Joe Biden blah blah blah, but it's not him at all. Although the White House did endorse this, it is 100% the FHFA in their doing, which is essentially Fannie Mae, Freddie Mac. And what they're doing is they are upcharging what they are called is LLPA, which stands for loan pricing. Give me 1 second here.
Loan level pricing.
Level pricing adjustments. Correct. Thank you. So what that means is it's not going to really affect you and get you a worse interest rate than so let's say you have a 760 credit score and you're comparing it to somebody who has a 660 credit score. The 660 credit score is not going to get the better terms just because they are adjusting these levels, right? All this means is that the person with the 660 credit score isn't going to have to pay as much as they were, and the person with the 760 credit score isn't going to get as much of a break as they once were. So they're just adjusting it a little bit, leaning more favorably towards not favorably, because that verbiage is used, and I don't want you to think that it's more favorable to have a 660 credit score, but leaning a little bit more towards helping out the person who has a 660 credit score. And the reasoning behind this is because Fannie Mae and Freddie Mac, after they've done, they do about 60% of our loans and back 60% of the United States loans. That was from 2022. Obviously, there's no stats out for 2023 yet, but why they are doing this is because they found out that just because a client has a 660 credit score or potentially putting a lesser down payment down, it doesn't mean that they aren't making their monthly mortgage payments. So all of those LLPAs are just based on a risk base. So it's not risky for them to give a loan out to a client that potentially has a 660 credit score and putting 3.5% down or 5% down, right? So that's why the adjustments have been made, because that's what they found out when they did all their statistics and stuff like that. So still better to have a top tier credit score, still better, I'm not telling any of my clients to go out and just get collections on it and make late payments on their credit card with a lower credit score. That would be absolutely stupid of them to do. And for that, it's not fair or not right that they're hindering the top tier credit scores. They're not hindering. You're still getting a better term for your loan when you go and have a 760 credit score compared to a 660 credit score.
So right. is the cutoff at 760? So if I'm at 759?
Yeah, so they're basically going tiers. So they go, just for an example, they go from like 7, they go in tiers of 20. So they go from 681 to, or they go from 680 to 659, and then from 700 to 7 up in, you know, how they kind of determine it.
Right.
I typically see the best increases that happen are going to be if you have over a 680 credit score or under a 680 credit score, and then anything over a 740 is going to obviously significantly help where your pricing in terms are going to be in terms of you getting an interest rate, where it's going to quickly, you know, your 740, 760 credit score, top tier credit score profiles are, you know, normally going to be about a % higher or better on their interest rate. And that's just gonna, like, 1% to 1.5%, that's just gonna lessen the gap, is what this is going to do.
Right. And I think, you know, there's social justice warriors on both sides of the aisle.
Yeah.
When you see people posting things about this arms, and
yeah,
I mean, perspective, it's FHA, and if you have a, you know, top tier credit score and have been saving up to buy a house, you're in a good position, you're more than likely not going to be going FHA. Now you could, and it could help you out with down payment, it could help you out with a number of things, and it could be a same somebody sell a property, a listing agent, everything's the same with a conventional versus FHA offer. FHA appraisals are a little more strict.
Yep.
You have things pop up that end, and so you still lean kind of more this, and now that seemed to be completely blanketed and covered that this is just for FHA.
Yeah, so this is actually,
this is conventional.
These specifically, the Federal Housing Finance Agency is specifically, Fannie Mae, Freddie Mac is conventional. So this would be helping conventional. But Jamie, I'm glad that you brought that up, because what people are trying to say that, oh, this is going to beat FHA, and although it will help, you know, the 660 credit scores guys and gals, you know, be able to maybe afford a little bit more or get a little bit better of an interest rate, I think that FHAs are still probably going to be better off of an interest rate. But what that would do is allow individuals with lower credit scores to compete with offers, because now they would be able to go the conventional route. And as you just said, every listing agent likes to see a conventional loan because of the appraisals are a little less in regards to guidelines and regulations. So, I mean, is it going to help out some people that are like kind of right on that border? Yeah, I think it could potentially, but I think that if you're going to compare FHA and the new guidelines and regulations and what an interest rate you could potentially get with this new adjustment being, it's going to, you got to depend on the client's specific situation and seeing what they ultimately are putting down and a couple of things like that. Everybody's mortgage isn't a cookie cutter mortgage. It's not one size fits all. It's very dependent upon every client's wants, goals, and needs.
So let me ask a quick question. Of the number of loans that you do there at NFM, what percentages are, you know, Fannie Mae, Freddie Mac, they're going to be impacted with some of these rules? What percentage is FHA? What percentage is, you know, the bank holding the paper on that these rules aren't going to impact? I'm just trying to get an idea of percentage of loans across the country that are going to see these new rules.
Yeah, great questions. Me specifically, the majority of my clients are going to be conventional financing. It's about 70-30, I would say. I would say that that's probably going to be the majority of the information as well. I do know that the average first-time homebuyer's credit score is between 700 to 720. So that's going to automatically put them in the conventional financing program. You know, could there be some opportunity to take advantage of FHA even if you are 700? Potentially. And that's why you have to look into those options. A good lender is going to look into those two options and compare, hey, should you take advantage of, you know, this FHA option because you can get a lower interest rate, or should you take advantage of a conventional route? It's going to be maybe a little bit higher of an interest rate, but you can have access to putting 3% down instead of 3.5% down being a first-time home buyer.
Sure.
Well, no PMI. It's a lower rate, different rate, but no PMI.
Yeah. So PM, and it also depends on what your down payment is, right? So, you know, if you have an individual that's putting 25% down, you know, you're probably going to go with the conventional loan because that eliminates PMI altogether. With FHA, no matter what you put down, you're gonna have to have PMI no matter what. So that's why I mentioned it's dependent upon every client's specific, you know, wants, goals, and needs in their specific situation.
And these new rules, doesn't matter if you have 20% down, 5% down, 50% down. Under these new rules, you're gonna pay a little bit more with that credit. Yep.
So I'm looking it up right now. Give me 1 second here. There's an LLPA like matrix that we have, and just to give you an example really quick. So let's say that a client has a 659 credit score and they're borrowing 75%, right? And this is strictly just Fannie Mae, Freddie Mac, so I'm talking conventional, not FHA at all. But 659 credit score, hypothetical, they're borrowing 75%, so they're putting 25% down, and their fee basically on what would be applied to them is 1.5% of the loan balance, right? So before these changes, you would have paid probably, hang on, it's 2.75%. So like on a hypothetical $300,000 loan, that's a difference of $3,750 in closing cost. But you know what that means for a 740 or higher credit score profile, they would have paid 0.25% on that fee, putting 25% down. After May 1st, after the adjustment is made, they're going to go up 0.1%, and they could pay as much as 0.375. So you see that it helps significantly with the individual that has the lower credit profile score, and a fee does go up of 0.1% on the higher credit profile score, but you're not getting a better term because you have a lower credit profile. They're just helping them a little bit more, and adjustment on what that would be charging you. You still get the better term if you have a 740 or higher.
So is the charge on the interest rate or on closing costs, upfront closing costs?
Yeah, and thank you for that. That it's on the interest rate, not on the closing.
Yeah, I was going to ask, what's the difference in the monthly payments?
Yep. Thank you. Yeah, it's on the interest rate, not on closing cost. Okay. But that's the percentages are still going to be the same. It's going to be the interest rate would still be that threshold or risk base is going to go up about, it looks like a 3/4 for a lower credit profile score at those exact 659, putting 25% down. Again, if you're putting different down payments down, it's a whole different ball game and thresholds, but this is what the whole LLPA matrix is made up of. I mean, if you typed in LLPA Fannie Mae on Google, it pulls up the matrix.
Okay. And so ultimately, who's getting that extra little percentage? Is that going directly to Freddie Mac, Fannie Mae, or?
Yeah. And that's ultimately why they increased the fee for what you would be charged for the higher credit profiles, because they had to make it up somewhere. So because they're lowering the lower credit profile scores fees that they would be paying, so that's why the higher credit profile scores got the little bit of an increase, because they had to make up and money makes the world go around, so they still wanted their money, and that's why the adjustment was made.
So then we see this movie back in 2005.
Yep.
I mean, you know, let's give everybody a loan. You know, you're punishing the people. I mean, in my humble opinion, you're punishing the people that have worked hard to get a good credit score by making them pay for the people who haven't taken care of their credit score.
Yeah.
And, you know, that's, I mean, in plain terms, it's called socialism.
Yeah. That's a great point. Yeah, I think it was The Big Short, right? But you know, it's not going to be that to that. Back in 08, 09, that was like the wild, wild west.
Well, sure.
There's still really,
but it was government induced.
Yes, you are correct.
I mean, the banks themselves would never have done what they did if they weren't forced to by the government, which this is the same thing. And, you know,
you are not wrong, Dave. You're not wrong.
I mean, I lived through it. You know, we saw what happened with real estate, and, you know, not that this isn't quite as crazy,
right?
But
right.
It's still, I mean,
taste of it.
Why not just raise the rate on everybody and say, hey, we need an extra quarter point from everyone?
Right. Yeah, and it's just, I mean, it's just the same. It's socialism. I mean, you're taking away from the individual that works hard and upping their fee a little bit more, and then adding and lowering the individuals who don't have a great credit score.
Yeah, what's the incentive to keep a good credit score?
Yeah, well, I mean, again, you're still going to get a better term if you have a good credit score. It's not like you're getting screwed over and the 660 credit score is going to end up getting better terms than the 760 or 740
Sure.
credit score. But yeah, it's definitely, I can definitely see both sides of it. I understand, you know, they're trying to provide and allow the little man or the little guy who the shot at getting approved. Do I think that it's going to be like it was in 08, 09? Absolutely not. There are too many guidelines and regulations that you have to qualify for a loan to do it. Is this going to allow some individuals to get qualified that maybe shouldn't? Maybe, but it's
that always happens.
Right, and it's going to affect a very, very, very small percentage of that. But I can see how it may leave a little bit of a sour taste in an individual that has get a top tier credit profile to put themselves in a really good position and to strengthen their profile to help their terms. And now they're going to end up maybe paying a little bit more on their monthly mortgage payment because of those risk adjustments.
So like on like the example when it's like the $300,000 house with 25% down or whatever, I mean, what is the difference on the payment for if I have a 660 credit versus 780 credit, 800 credit, what's the difference on the monthly payment?
Oh, I mean, it would come down to, you know, if it's primary or investment, et cetera,
well, yeah, assuming it's a primary, they're both the same thing.
I mean, you're probably seeing now, or you will probably see the interest rates of like 0.75% to 1% different. Then after these adjustments, you might see, you know, anywhere from 0.5% to 0.75% of a difference in favoring the top tier credit profile on the interest rate, which, you know, is going to effectively show probably like the top tier credit profile is probably going to pay $30 to $40 more than what they would have with today's currency and comparing to when they make the adjustment next week.
Yeah, so it's not a great deal of money. It's just
right, but I mean, money is money.
Sure,
it's enough to pick you off.
Yeah, well over 30 years. It's a decent amount.
Right. So I mean, what is that? $40 and $480 a year, right? The average person is in a loan, or in the first time home buyers at least are like 3 to 5 years, 3 to 6 years. So, I mean, over a five-year term or 5 year, it's $2,400 that you could potentially be paying difference on what you would today. if you got locked in on an interest rate today.
Yeah,
Well,
'cause,
yeah, 5 years, I guess, but they're going to move and own something. They're going to own for the rest of their life. So, I mean, it's always there.
Yeah.
So it's just there forever.
Yeah. So, and
And it'll probably get worse as time goes on.
yeah, hopefully not. You know, we say hopefully not, but you're probably right.
fingers crossed.
Yeah.
They accelerate.
Well, here's the. I mean, I would imagine that if you surveyed 1,000 mortgage brokers like yourself, Ryan, it would seem like to me most of you guys would say, yeah, we could probably find a different way to do this, a more practical way to do this. And you know, my whole problem has always been, you got all these really super smart guys that, you know, graduated from Cornell, Harvard, MIT, whatever, that are down there in the government, and they've never held a real job, and they don't have, I mean, this is all theory. This should work. And then when they put it into practice, they find out, this didn't work. Yeah. And, you know, there are 38 different directions. It always seems like to me, we got a bunch of checker players versus chess players. You know, we make one move at a time and then we respond versus looking 4, 5, 6 moves down the road. And that's why I say, I mean, during the foreclosure crisis, I said many, many, many times, bring 100 of the top real estate agents across the country. We could solve this problem in about 20 minutes, you know. But when you get these guys in government, and I can go on and on, I'm sorry, but it's kind of crazy that, you know, let the banks decide who they want to loan to.
Yeah.
I mean, if Huntington Bank says, you know, Dave Barlow, you're not a very good loan risk, then why is the bank being forced to make a loan to me?
Yeah.
And that's what it is, because if you don't do this, we're going to withhold your federal money.
Yeah.
And so, anyways, I appreciate.
You're not wrong.
I appreciate the explanation.
Yeah.
Doesn't take the sour taste out of my mouth, but I appreciate the explanation. Well, you have your hands full, that's for sure, just like we do on the other side of the street.
Yeah, I know this upcoming probably month, that's what we're going to be explaining.
Yeah. So need to get a recorder. Hold on a second, please. Please press.
Yeah, I'm going to send you this video.
There you go. And you can listen to Dave bitch about it.
Dave the curmudgeon.
That's right. The old curmudgeon guy sitting over in the corner.
You should go to TikTok, the curmudgeon broker.
There you go.
The Grinch of real estate.
There you go. I'm trying to get people into houses or out of it one way or the other. I'm not trying to make it more difficult. No. Just let things be. All right, guys. Thank you.